Hello, everyone, and welcome to today's presentation. We are excited to bring Back to Business webinars alongside ICCFA and Live Oak Bank. Today, we will discuss how to make a profitable business decision. My name is Tim Bridgers with Live Oak Bank, and I'm pleased to welcome our special guest, Tracy Beck with the 60-Minute CFO, and Nelson Tulane with Johnson Consulting Group. I also want to thank ICCFA for hosting this webinar, and I truly believe, and I believe the panel will agree, that this content is crucial to the success of your business. We would ask that you please post questions throughout the webinar in the Q&A section, and your questions will add tremendous value to the content, and we highly encourage you to participate in that. So with that being said, I would love to turn it over to Tracy. And I'll let Tracy tell you a little bit more about herself and background.
Thanks, Tim. And thanks everyone for being here. I'm excited to talk to you today about how to make a profitable business decision. And my work with 60-Minute CFO is focused on making sure that business owners and business leaders who are not financially savvy can better understand what their numbers are really telling them.
That's great, Tracy. Yeah, I think it's absolutely crucial. And we're excited for your perspective today and insights. And I really appreciate you being here. Nelson, I'll turn it over to you. Tell us a little bit about yourself and background.
Well, thanks, Tim. I've been with Johnson Consulting for about 7 years, but I've been a funeral director, managing and owning funeral homes for over 37 years. It seems a little bit over the top, but it's been that long, and been everywhere from small mom and pop operations to large corporate firms. And it's given me at least that perspective to be able to look and see businesses from all different angles and hopefully help people be the most profitable operations they can be.
Absolutely. Again, we appreciate you taking the time to be here. Live Oak Bank, again, Tim Bridgers with Live Oak. I lead the funeral home and cemetery lending team here at the bank, where we've had the honor and pleasure of serving the funeral profession since 2010. And it's been very rewarding emotionally, just to be a part of such a wonderful profession with wonderful people. So we appreciate all that you do on the call today. And Tracy and Nelson, thank you for taking the time to be here. So I get really excited. I know, Tracy, we've spoke about this one-on-one. Nelson, we've talked about this one-on-one. I get really excited when we talk about how to make a business decision, because I actually believe it's an overlooked topic. You know, I ran a business for 11 years. Tracy, you're running a business today. You have a consulting group. You're helping with your father's book and push that whole message. Nelson, you're running a segment in Johnson on the consulting side. And all of us have to make decisions. And a lot of times we make those decisions based on our gut or based on what we think is right. And sometimes we get so busy that it's hard to take the time to find the right data to ensure that the decision we're making is adding value to the organization and not what the terminology says as destroying value, which is really easy to do. And when we make decisions that destroy value, that's when we start seeing decreased margins. We start hiring out of impulse and emotion and not need. And I think this creates some potential headwinds in your business. So today, our goal is to bring some awareness to some key data points that you really need to be thinking about for your business. And if you're not keeping a pulse on these key metrics that we're going to talk about and methods, maybe as a result of today, you can start thinking about this a little bit more intently. So with that being said, Nelson, I want to turn it over to you to kick us off. You've been so kind to share some of the key metrics from a financial analysis perspective, and we'd love to hear your insight on some of these benchmarks.
Thank you, Tim. So this information actually comes from our merger and acquisitions department through the time that they spend looking at funeral home and cemetery financials and helping with the brokering of various deals. We get the opportunity to pour over a lot of material. And from that, we've been able to develop some benchmarks that people can look at, and we can see at a glance where there's areas that need to be revised and revisited. I will say this, though, benchmarks are just averages for the world. Each individual will have their own specific set of circumstances that they have to play to. I led to body styles. Body shapes and body styles are very similar to businesses. They've got a lot of variety to them given their circumstances. And something that we all can relate to is losing weight. And if all you do is say, I'm going to lose weight, that means nothing. But if you set a goal, so any one of these, if you say, my personnel expense, I'm going to set a goal to it. But if you just say, I'm going to reduce it, or just some ambiguous, expectation, you need to set a number, and that number will drive what your strategy is. If you said you wanted to lose 5 pounds, that has a whole different set of factors than somebody who says, I need to lose 50 pounds. So think about that. This is a good rule of thumb. You can gauge yourself against the rest of the world, but don't let it be a driving force. You really need to look at your specifics and what you need to do in your environment and your competitive situation.
Yeah, Tracy, I'd love your input on some of this data. When I'm looking at it, there's some areas that definitely I think most businesses could improve on related to these margins. Do you have any thoughts?
Well, I definitely want to piggyback a little bit off of what Nelson said, and just to kind of emphasize what Nelson has, what this data is. And like he said, it's an average, but you'll also notice that those industry standards are percentages, and we aren't looking at actual dollars. So like he said, 5 pounds, like what is that? What percentage is that of your total body weight? It is, another way to think of it. So you intuitively know that if you have to lose 5 or 50 pounds, one is going to be more of a higher percentage of your body weight than the other. So these are percentages of your total revenue, right? So he's instantly been able to make this relevant to your business. So your cost of goods also has a dollar amount associated. And what happens in business finance is by default, all of your bookkeeping software and most of the reports you look at only have those dollar amounts. And very rarely do we actually add in those percentages of revenue. But when we do, you instantly have a better metric to understand what your numbers are really saying, because you now see your cost of goods, which may loom large in your mind as a large dollar amount, is in actuality 13 to 18% of your total revenue. And same thing with maybe advertising and promotion. It may seem like a large dollar amount, but when you tie it back into what it is as a percentage of your revenue, you see it's 3%. So I think that first, we take it very back. This is a basic thing about benchmarks, but it's also the first step to understanding all of business finance. Is you always want to look at your numbers in relationship to another number. That's a first key thing to do. Yeah, Nelson, I don't know if you have more to say about that. I could kind of go on about benchmarks, but that's kind of one of the first things that hops out at me.
And you're exactly right. In fact, the reason we use the percentages for all the things that you alluded to, and as well as whether you're a $1 million operation or a $10 million operation, the health and welfare of your business still relies on that percentage to revenues. And it's not rocket science. It is, you take that dollar amount and you divide it by what your revenue is, and you get that percentage. So you don't have to be a mathematician to figure it out.
Exactly.
Yeah, from a bank's perspective, this is so meaningful, right? When I look at these margins, I'll tell you that, when a funeral home contacts us for a loan, one of the first things we do is look for that EBITDA margin, which is at the very bottom, right? We're trying to solve for that. And as you all know, every business is different. Their expense structure is different. Their capital expenditures in terms of major renovations or repairs are different. We want to see how well the business has managed their expenses year to year. And what's really impressive is if you're a business that actually has experienced a decline in revenue, but you've been able to show an increase in that percentage there. We think that's a very positive sign of a business owner that's really in tune with their business. I'll give you another example. We look at the personnel cost. As Tracy mentioned, 30 to 35% is the largest percentage on the screen. And it's often said it's one of the fastest ways to increase your margin or save money by ensuring that you are efficient with your staff. Okay. So what this does line by line, when you look at cost of goods, it causes you to think about your vendor agreements. It makes you want to look at your contracts on an annual basis. Every one of these lines will create behavior, right? It will cause you to want to do things to ensure that in every category you're within the average, or you at least have a target to improve. I like what Nelson, what you said about weight loss, actually, because as you mentioned, 5 pounds is the target, and we know that's a healthy percentage of weight loss for me. Okay. That goal is going to force you to change your behaviors and habits. It's the same thing with the business, right? Cost of goods are too high. We're way out of the whack in terms of compared to our peers in the industry. What is our first goal? Well, maybe we're going to get that, that 25% down to 20%. By the end of the year. So if you take this approach with each one of these margins, you can see how it's starting to help your decision-making. And if you go back to the title of this, we're talking about how to make a profitable business decision. Okay. So again, taking your time, understanding how your business translates to these benchmarks, using this as a guide can really start to help you really start feeling confident about, making business decisions. So Nelson, we're going to come to you on the next question, and then Tracy has a few slides here that she's going to dive into and share. But in your time in the profession, Nelson, from the consulting, from the broker side, representing some people looking for financing, looking to sell, how have you seen poor financial management impact the sale of a business? And I'm sure you could talk about this for 8 hours. But what are some things that stick out to you that are maybe themes that our folks can learn from today?
Yeah, when you say that, if you were part of my family, you would know that's all too well. I can go on, so I'll try to be brief about this. But one, like Tracy mentioned, first of all, having numbers that you can relate to, looking at the trends, are they improving? And then relationship. For instance, one thing that we look at is if you had call volume that went down in a particular year, and what did that call volume go down by? Was it 2 or 3%? But then part-time labor went up 60%. It just doesn't have any practical relationship to that. And so looking at historical trends and where you're going, a little bit something about on the previous slide, Tim, you talked about that EBITDA is a number that relates to the management of the business. It stands for earnings before interest, taxes, amortization and depreciation, all those things that we really can't control. Mm-hmm. But everything above that line we can. And that's what we're looking at all the time, is that historical trend year over year. When we create budgets, we're looking at what has the business done in the last couple of years, start with call volume, look at what our expenses are, how they change over time. And that, I guess, the biggest part, we come from a long history of, looking at the neighbor's GPL and trying to figure out what they're charging families and matching ourselves to them. That world has gone away. Now, for the strength and well-being of your own business, you have to look at your own numbers, and you have to charge what you have to charge in order to, first of all, recover your costs, and then second of all, to make a decent profit, not only for your own personal needs, but eventually, like you said, if you go to sell your enterprise at some point in the future, you got to be able to demonstrate that it's a profitable enterprise. Otherwise, really nobody's going to come knocking.
Absolutely. And on that point, Tracy, talk to us a little bit about the difference between cash flow and profit. Nelson, you teed that up perfectly.
Yeah. So I know it's hard to believe if you are like me and for 20 years ran your business by kind of seat of your pants management, I call it, or bank account balance management. But like intuitively, when someone tells you cash flow does not equal profit, it sounds wrong, but I think I can make it sound right when I remind you that when you look at your income statement each month and you see your net profit on the bottom there, if you were to go look at your bank account balance, those two numbers will never, ever be the same. So the cash is what shows on your bank account balance, and your net profit is what shows on the bottom of your income statement. So how are you supposed to know what your actual cash flow is, right? Like if neither one of the balance sheet nor the income statement is showing me how much money is going to be in my bank account, how do we know? Well, we have to first really accept that there is no relationship between cash flow and profits. And the reason is because when you go after more profits, the inclination is to go after more sales and revenue. And oftentimes when we go after more revenue, we have to increase the amount that we spend. And sometimes we have to increase our assets. Maybe we have to buy more things in order to sell more things. And what can happen is we will spend a lot of money in order to make that money. And a lot of those, if we buy assets, will show up on our balance sheet as assets and will affect different relationships in our business, not any of the metrics that Nelson showed, but it will affect how our profits are. So what we need to do is accept the fact that there is no relationship between the two, and then start monitoring our business on a regular basis to understand what that relationship is for our business, which I could go on for probably, a couple more hours. I teach a course on that alone. But that's one of the most important things that as business owners, we really need to understand. And those benchmarks will help us. If we can always see what our cost of goods are as a percentage of our revenue, that's one really great important place to check that if revenue goes up, our margins are either staying the same or getting better. So that's probably one of the most most dangerous things we can get into as business owners when we go after growth or change in our business.
Yeah, it's a really good point in separating those two and not living by the balance in your checking account, but really living by what your operating margins are. And if you're improving those margins, there's a pretty good chance that you're going to see your cash flow situation improve as long as you're not going out and spending that earned or improved cash flow on random things for the business. So that's a really good point to make. And if you are managing per the current cash balance and making decisions on that cash balance, you're probably not looking long-term enough. You're probably not making goals that are far enough out in advance for your business. You're probably living on a month-to-month basis, and that's probably not the healthiest route to take. So
something, just to interrupt for a second, because
Sure.
Tracy made such a good point, and one that probably I hear on every first call with anyone, is they'll say, just as Tracy said, we had a really good year, and yet I look in my checking account and there's nothing to show for it. And one of the first things, and we're traditionally very, very difficult for us to solve this, is accounts receivable. As caregivers, we really don't force that issue nearly enough. And that's usually the first thing I respond to is, how well do you do on collecting your accounts receivable? And we're not the best, and we don't want to badger our families and things like that. But at the end of the day, you can do and serve all the families you want, but it doesn't count till the cash is in the bank. And AR is one of those things that, again, with a strategy in place and proper guidance and monitoring, you can solve that. So that's the encouraging part of it. If you see that as one of your problems and you know that accounts receivable is an issue, it's one of the easiest things you can fix.
Absolutely. Thank you, Nelson. That's so true. And if you have questions about this, we encourage you. And it looks like we actually have a question that came in. It says, does the industry standards apply to cemeteries as well? Nelson, I'll let you answer that question.
There, obviously, funeral homes and cemeteries operate differently, and there is a different set of benchmarks for cemeteries. what I'll do is afterwards, I'll get that to you, Tim, or if anybody wants to reach out directly, I'd be more than happy to share that with you as well.
That's great. And Laura, thanks for the question. I encourage all of you to post questions as you think of them. It'll make our content very rich for today. So Tracy, let's talk a little bit about the 4 phases of business. We have some really nice slides here to talk about this. So I'll let you take it from here.
Sure. Thanks, Tim. This is one of the probably the more, I think it provides a level of a little bit, I want to say relief when business owners learn about these 4 phases, because when you see a benchmark and you compare yourself to it, it feels like a judgment has been cast on you and your business. But it's really important, and Nelson hit on this as well, that you take into account what your previous historical benchmarks have been. So always really competing with yourself, right? Always comparing to your previous period rather than always having, the industry benchmarks speak for you. But this is the 4 phases of business are another really important thing to keep in mind as you look at your financials, because the benchmarks are different for a business that's new versus a business that's mature. So with that being said, the 4 phases are startup, and there's correlating these fun rhyming words that go with it. So startup is also known as the wonder phase. High growth is known as the blunder phase. Maturity is known as thunder, and decline, which is plunder. So I think the next slide, Tim, just kind of takes you through it. As you're listening, you're probably going to instantly resonate with where you are in business. Startup is, when you first open your doors, and the characteristics of a startup are, you don't come into business typically with a lot of capital or equity. So on your balance sheet, you're going to see that reflected there. You're probably going to have negative operating cash flow and low profitability as you get your business off the ground. You come in, unless you've got some experience somehow, and everyone's done this before, your management might be really inexperienced and somewhat weak. And then also, you don't know what you don't know. You're not probably going to have very much in the way of financial information. So you may have it, but it might be somewhat incomplete. So we're wondering if we are going to make it to the next phase of business. And, most of what we're talking about today is totally foreign because we're focusing in on the craft or the service that we provide. So the second step is high growth. And this is when you have a viable business because you're getting a lot of customers and you're starting to see things increase. So you're going to see a high growth in your revenue and in your profit, which is very exciting. However, anyone who's gone through this knows it's also very stressful because you're going to have very strained capital to sustain the growth. So it's this like dollar in, dollar out, or maybe $2 in, $4 out in order to keep the pace of growth happening. So and that's number 3. That's a negative operating cash flow. So we see profits on our income statement, but we don't see any in our bank account. Very stressful. So we then have a need for some more formal management, and we're probably getting a little further in understanding our business finances, or at least having bookkeeping. This is known as the blunder phase because so many people, just when the going gets good, it also gets tough and they don't make it to the next stage. So the important thing is, if anyone listening feels like they're in this phase, keep going, but get an understanding of your business finance, because the concepts that we're talking about today are what get you to the next level. So the next level, the phase 3, maturity, is the thing that when you dreamt of starting your business or are buying in or coming into it, is where you pictured you would be, because everything's running like clockwork. You have lots of built up equity over time because the business has been operating with some retained earnings. You have solid profitability and finally have gotten ahead of the cash flow so that it's positive. So in other words, you do have more money in your bank account ongoing. You've got more experienced management, and then your bookkeeping, your financials are timely and accurate. And the fun rhyming word is thunder. Nothing can stop you in this phase. Your goal is to stay here. There's the next phase, though, is very tricky. So the next phase is decline, and you'll see it looks a lot like thunder or maturity, because things are still really good, except for they're just a little bit lackluster. And the tricky part about being in this phase is it's not obvious. It's until it starts to get much worse. So you'll see you still have strong equity and you have strong, but it's declining cash flow. And the only way you would know that you have declining cash flow is if you are measuring it period over period. So I'll just put another plug in there for taking a look at your financials on a regular basis, because you'll be able to see cash flow going down. Still really good, but not as good as it was. Same thing for profitability. Still really good, but not as good as it was. And then you're starting to see probably the leadership is getting a little bit detached, or we want to keep everything status quo. And I'm sure everyone has heard the words, if you're not growing, you're shrinking. And that's kind of what we are talking about here. It's very hard to stay on this tip of maturity without needing to go back a little bit into high growth or getting yourself into decline. So what do? We look at our financials so that we can determine if we have hit maturity and are starting to creep into decline. If you find yourself here, it's time to take a new risk. It's time to bring in the next generation of management. It's maybe time to sell the business, but you definitely don't want to spend too much time in decline. It's not a fun place to be.
Yeah. So Nelson, this brings up something that we see all the time in terms of being involved in the transaction. And I'd love to hear your input on this. You have a business that's floating between maturity and decline in the funeral profession and cemetery as well. When I say funeral profession, I'm just assuming all encompassing. But what I see happening is decline creeps in near the end of the current owner's tenure. And that's probably the worst thing they can let happen, right? In terms of, most recent year valuations and how that impacts really the strength that the buyer has in negotiating. So I'd love to hear your input and emphasis on how important it is to really watch those two phases, and maybe some tips on how to stay in the maturity phase or high growth phase.
Well, again, Tracy said it exceptionally well. It's one of those tricky things. It's a little bit insidious. Going back to the whole weight thing, if you're not watching your weight, it can get away from you. But I would use this as an example that's been coming up recently in our budgeting talks with clients. But we talk about limousines. A lot of funeral homes, they've had limousines. They've used them ever since their grandpa was around. But now they're at the point where, our limousines, they need to be refreshed, or, was at the last convention and looking at them. And then the question comes up, but why? When's the last time you consistently have used limousines? And they're looking at taking on a huge expense from so many different levels for something that if, again, they were looking at their trends, they'd see that the value of that particular piece of equipment probably doesn't even come close to what the outlay of cash is for it. And then, a double dose, what they get is they've had for years and years on their pre-needs, they've included a limousine because it was there, it was in the garage, and why not throw a little bit of extra fluff onto it? But now you've got a pre-need that if you are going to go away and not maintain your limousine anymore, and yet you've got that built into a pre-need, now you've got a liability of providing it from an outside source. And so now you're twisting in the wind on whether or not do we spend that much money for something we hardly use, or do we need it just to offset our commitments on pre-needs? So it's that kind of discussion that you really have to start to look at and decide, all right, we're going to go away from that traditional way of doing. I know we've always done it and we're maybe known for that. But what you're known for is being a company that's been around for a long time. And if you don't pay attention, you won't be there for another 100 years. And so it's so critically important. And again, back to Tracy, it sneaks up on you, and that's what takes you by surprise. And especially when they come to you, Tim, and they're thinking, gosh, 20 years ago, I remember somebody was offering us a lot more cash than what they're offering now. And part of it is the business is not the business it used to be.
That's exactly right. Cash flow and margins is absolutely crucial in the most recent 2 to 3 years of a business in order for it to get the most value. And it's extremely important, but that's easier said than done. it's more common for the current owner to be getting to an age to where that's getting more difficult for them to bring the same amount of energy to the business. And I would say that that's an encouragement that I would give to the viewers today, is that if you are in that position to where you're getting to a point to where you're feeling a little bit more detached, you just don't have the energy, maybe the charisma, that's where you really want to make sure you have a succession plan in place with a current manager or key employee, or working with someone like Johnson, a consultant, to really help make sure you're making the right decisions related to the margins. And how do I stay in this mature phase? Or how do I balance continued growth while maintaining positive cash flow? Because that cash flow is what's going to finance your next buyer, most likely. So it's incredibly important to stay focused on this and to identify what stage you're in, right? Tracy, I mean, as you mentioned before, there's a reason that you are outlining each of these and explaining the characteristics, because a business needs to be able to quickly identify what stage they're in, right? Isn't that important?
I think so. And I think it's because also, you're going to feel different. It would be silly to say, while we're talking about numbers which are black and white, that there aren't a lot of emotions tied to each of these phases, right? And the only one that's very comfortable is phase 3. So when you're uncomfortable, you need to determine why and which one of these phases best describes that discomfort, because there's different strategies and tactics that you can employ. If you're in phase 3, what you're going to do is very different than what you're in phase 4, right? Like your strategies need to be slightly, very catered to what phase you're in. And, as busy business leaders, we all have limited amounts of time to work on our business, right? Like your day-to-day is primarily not managing your finances unless we have some controllers, bookkeepers, or CFOs on the call. So when you're busy and you're leading, you gotta have a sharp knife, right? You gotta be surgical about what you're gonna do. So I think it really helps to have that.
Absolutely. Before we move on to some key tools that's necessary to have this clean data, Tracy, let's talk a little bit about the 3 levels of profitability, because these, again, are 3 different metrics that are important to understand, and because they are a measure of your performance and your management. So let's highlight these if we could.
Yeah. So speaking of being surgical, if you are looking at your income statement and you do not like what you're seeing, in other words, your profitability isn't where you want it to be, it's not where Nelson told you it could be, then what do you do? Well, the good news is that there are 3 levels of profitability. We talked about EBITDA, which is darn near at the bottom, right? But it's pretty close to your net profit. And there's 2 levels above that, which are the operational profit margin and your gross profit margin. Now, I won't go into the exact dollars and cents that all go into those things on your income statement, but the good news is that there are some key battles we can win here in order to try to win the overall war. So the very first thing that you want to do when you notice that your profitability isn't quite right is start at the top rather than at the bottom. So if I gave you the task of increasing profitability and you had to look at every single thing on your income statement, you would have a big chunk of work in front of you. But when I say start at the top, I want you to look at just those direct costs of goods. How can we make more money on what we are spending in this department? Or how can we spend less and make the same amount of money? So normally it's not a huge list of accounts to review and look at. And when you save, let's say you save 1 to 2% at the gross profit margin level, the good news is that goes directly down to your net profit, because it doesn't need to go through and spend more money on the operational level. And then the other good news is, let's say you've achieved that 1 to 2% increase in profit. The next step you would do is attack your operating expenses. And this is normally a much longer list of things because it's all of your overhead. It's like office supplies, it's your office manager, it's the landscaping, it's everything you do on an operating level that isn't directly tied to making revenue. So if you were to, let's just say, attack each of those and try to save 0.5% to 1%, and there's 10 items on there, you could do a 10 to 20%, 5 to 10% increase in your revenue. or in your net profit, because again, that's going to go right down to the net. So between, if you did 1 to 2 at the top and 5 to 10, you've got a 7 to 12 increase on the bottom line. And that's significant, right? So I just wanted to give you a surgical approach to helping understand how you can make some profitable decisions, right? And where in here can we, save, or, what could we do to increase revenue that wouldn't increase any of these costs? And starting at the top is the key.
That's right. And that brings up the topic of variable versus fixed cost, right? Anytime we have a fixed cost in the business, we should continually revisit that cost to ensure that it makes sense for the business. It may make sense this year, but as we enter the following year, conditions may have changed. So there might be a new product out there that offers a more variable expense. And why is variable expenses important to the business? Well, if the usage is low, then the cost is going to be low. But if you're locked into a fixed expense on an item that you haven't paid much attention to for years, and you're just doing it because it's what you've always done, you could be missing out on some of that free cash flow and operation margin that we've been talking about. So again, just making a list. I would encourage you to make a list of all of your fixed expenses, all of the ones that vary based on usage, the different types of services your customers usually ask for, request, whether it's delivery service, all those things. Make a list of those and see how many of the fixed you can translate over the variable, and you might see a great improvement in your operating margin. I'll tell you, most often we're all the time talking with funeral home owners about how to improve their call volume, how to improve the revenues. We're talking to cemetery owners quite often. Well, how do I really improve this margin? And I'll tell you that a lot of times you can drastically improve your income just by doing what we've talked about today and never gain that additional call. And then when you do gain that additional call, it drops right to the bottom line and makes a significant impact on the operations of your business. I would say that you certainly should be thinking about what you need to do to get the next call. But if we focus so much on that, sometimes we end up investing and spending more than we're getting back on that time and effort. So as we
Tim,
go ahead, Nelson.
My apologies. I dropped off there for a second, but what
Sure.
you just said, and something that Tracy mentioned before, go back a slide or something on the different profits. The key thing there is all of those are a measure of your revenue after you've subtracted something. Mm-hmm. And that's the key. We do oftentimes, you're in a group of funeral directors and they're all talking about call volume and casket sales, and they're all looking at the revenue side of it, or what generates revenue. And the truth of the matter is, what makes or breaks you is what it costs you to operate. And expense is always a one-to-one falls to the bottom line, which is just what you said. And I just wanted to reemphasize that, because so oftentimes you hit it on the head. We're looking and talking about how to grow the business, and maybe the most profitable thing you can do is how I can run it more effectively, more efficiently, and that's the key.
Yeah, you also hear a lot of personal financial consultants that are talking about your personal finances. Really encourage people to sit down at the beginning or the end of the year and look at your own finances. It's amazing how we can accidentally apply for these subscriptions through all the services we have, or maybe the power bill or your cable bill creeped up and you didn't even know about it. And there's a much better option. I'll be honest, this year I did that at the beginning of the year, and I was blown away at what I was paying on little things that I really was overlooking. And I'm a person that actually looks at every line item every month, and I still was overlooking a pretty significant amount of expense. So I know that if we can do this on a personal level and look over these things, we certainly can do it when we're running a business. I'll tell you, I sympathize, because I went from the entrepreneur to the W-2 employee. Okay. And I will tell you, as a W-2 employee, yes, I have a lot to do, but I don't have to focus on all the things that an entrepreneur has to focus on. So when you got to do that and you got to focus on your personal expenses, trust me, there will be expenses that you should not be paying that you are not aware of. there's a very, very good chance of that. So like Nelson said, that's one quick way to improve your margin and your free cash flow. So what are some ways to do this? Well, we've been talking about information, assuming that you actually have the data to make the decisions. Okay. And it's crucial. It's crucial as a bank when we're looking at your business and its financial health to determine if it's financeable or not. And we have to have accurate data. And we really like to have accuracy over a 3 to 4 year time frame. Okay. What do I mean by that? Well, if you're switching accountants and accounting methods multiple times over the course of a 3 to 4 year period, it can make things challenging. It's not impossible, but it'll make it challenging. Also, if you don't have industry specific professionals, accountants that understand the profession, the language, the strategies, the characteristics of the business, it could potentially set you back in terms of how profitable you otherwise could be. Nelson, I'd love to hear your take on this, because you obviously are talking with funeral professionals every day. What's some of the areas that you see most lacking relating to good quality data to make a judgment on the business?
Well, you hit upon it, and I'll say it from this perspective. As being an industry-specific person with experience, I know the relationships that happen, and I can appreciate that. What typically happens is you've got your local accountant, the lady that you work with, you go to church with maybe or whatever, and you might even bury people in their family. And so God forbid that you wouldn't use them, because maybe they wouldn't come to you. And so we do use those people and totally understand why you wouldn't want to move away from that. But we do see that all the time, where they don't fully understand the funeral business, and even something as simple as cash advances that they put into the cost of goods sold. And, if you're doing cash advances right, they're running through your business, but they don't impact the business if you're, again, collecting your AR. But all of a sudden you put it into your cost of goods sold, and that's the first item on the list that Tracy shared. Your gross profit is suffering. And if you don't point that out to you, I can guarantee you somebody else coming along to buy your place isn't going to point that out to you. Another reason why, as far as using a broker that can look at your books and say, boy, oh boy, you've got something here that's dramatically affecting what your EBITDA looks like to the world. And it's all just because of poor coding. And that would be the other part, and one that I harp on all the time, and that is an accurate and agreed upon chart of accounts. And the agreed upon part is probably the most important thing between the owner and your bookkeeper or your accountant, whoever that is, that everybody's putting the dollars into the buckets that everybody agrees upon. The truth of the matter is, you can look at the bottom line and it may not change, but if you don't have it in the correct buckets, you can't analyze those expenses. And it goes just back to what you said, Tim. You're looking at numbers in your own personal life, and it's hard to believe you're spending this on something. But if you don't even have the right things in the right, so, if you're looking at entertainment costs for your own personal goal, and somehow or another entertainment is also linked into your grocery bill, because maybe somebody thinks, well, you buy popcorn at the movies, so we're going to put that in the grocery bill. A $13 tub of popcorn is going to throw off what your expenses are for groceries, and you won't be evaluating that correctly. Yeah, so somebody says, well, I can't stop eating. Yeah, but you could stop going to a movie all the time. And if that's what it took, you wouldn't even know it, because you don't have the proper detail of the information to make a good decision. So for me, the ground level part that you need is have agreed upon an accurate chart of accounts. That can come from somebody. You can create it up yourself, but everybody's got to be on the same page.
Mm-hmm. Mm-hmm.
Absolutely. And I'll say that this takes a constant effort. This is not something you do one time a year, even, in my opinion. is something that you've really got to look at least once a quarter, if not once a month. Because new expenses for the business are going to be required. If you offer a new service, there's going to be a different kind of expense. If you change your service provider and they got 2 different subscriptions instead of 1, you've got to constantly look at these expenses and make sure they're in the right buckets, or all the margins that we talked about are going to be skewed and it's not going to have the same meaning. Mm-hmm. So that is absolutely important. So Tracy, I want to hit on another set of metrics that are important. We've talked about the accounting data, how important it is to have that clean and organized and properly allocated, but there's some non-financial data that is crucial too, to manage too. And we've talked about the finances. We've talked about, as an owner, the ability of the owner to make decisions to improve their profitability. But what if they don't have data related to how their employees are feeling? What if they don't have data related to how their customers are feeling? Which, Nelson, I know you have some input on that too. But Tracy, what are your thoughts related to how important that is?
Right. So numbers are great because they're black and white and we can measure them, and we can get bad numbers, we can get good numbers, but the numbers are numbers. The mm-hmm. other thing though is that we don't want to do this in a vacuum, right? So first of all, when you sit down to do any kind of business decision making, you can totally make this a team effort with your key leadership team. The key leaders in your company are going to have ideas and be able to help you strategically align with whatever your goal may be. Mm-hmm. The other really, really beneficial thing you can do is when you share your goal and practice even some degree of open book management, so that they can understand how the company is doing and things that they do impact the bottom line. It becomes a really dynamic way to increase your performance. So getting feedback can be directly related to the finances. It can be also related to all aspects of the business in terms of how all of the departments are running. Doing a regular audit of just your overall level of performance, right? How are we operating in the sales team? How are we operating on a marketing level? How are operations doing? Can all be really, really beneficial to round out what you're seeing in your numbers. And then, so Tim mentioned inside the business, but also outside the business. How are you perceived by your customers? How did we do? Collecting reviews and understanding how you are perceived will give you so much insight for improvement, but also just to acknowledge all of the areas of excellence already happening as well.
So Nelson Johnson does this, right? In terms of customer experience and keeping a pulse on that. So I'd love to hear your input on the customer side of the data.
Yeah, I'll say this too. I always enjoy being on these panel discussions because what Tracy says and what you say, it's validated by what we do and things that each one of us is talking about. You're not just getting it from one source, but it lends a lot of credibility when you can see everybody talking about the same thing. Tracy, again, pretty much said how we approach our reviews of businesses. We look at them from 4 main buckets. First, customer service, then the workplace, how is everybody getting along inside the walls? The marketplace, how are we perceived outside the walls? And then finally, the financials, which we've spent most of this time talking about. To the customer service end, yeah, I'm very proud of the fact that arguably we're probably the largest surveyor of post-family or post-funeral families out there. And once again, very valuable to have insight into your own world. In fact, we always comment that your financials will tell you the state of your business today, but your customer service will tell you the state of your business tomorrow. Yeah. That NPS score, knowing the relationship you have with the families you've served, if they're advocates for you out there and telling other people that God forbid something happens, go to ABC Funeral Home because they're just simply the best. Developing that, and there's another comment that we make, a quote from John DeJulius, who is world renowned in customer service, but he says and talks about the level of customer service and that experience can make price irrelevant, which I think everybody that's ever taken a shopper call would like to approve that. But you think about it, it's Starbucks, that's everybody talks about it. I don't care. I just like the experience. And families that are treated well and they have an experience that goes beyond just going through the motions and providing what was paid for, they're your advocates. And again, we could talk about so many different values and criteria, but net promoter score is another thing that we survey for funeral homes. And I think early on, I think it was Tracy that mentioned, there's, 100 different points of which can be evaluated and looked at. And we do that through the course of the questions that are given to families, and then also the verbatim comments that they provide tremendous insight into the operation of your business. And you can do that, the same thing. You can do it for your employees, where you do an employee satisfaction survey and get to know what that ENPS score, the employee net promoter score, in a world where we struggle so much to find good quality employees, which is arguably, I would say, the biggest concern that funeral homes have out there, having a good work staff. If you had your entire team promoting and encouraging people to come and work because it's just a wonderful, giving environment, you'd be halfway home. And then again, the marketplace, that's another interesting part that I think, and again, this, self-serving commercial here, but the one thing that the surveys that we do are linked to sales contracts and performance that way. It's the only place where you can get the combination of the nuts and bolts of buying and selling, and then also linked to the comments back from the families. And there's such insight that you get, especially, again, this time of year. Probably most people are past it, but they're looking at their GPLs and what they need to add to them in order to, like Tracy said before, if you're not growing, you're going backwards. You have to increase your GPL, and yet funeral directors as a whole hate to do that. And their employees, the arrangers who are frontline with the families, they absolutely hate to see GPLs going up. But you get the surveys back and you see the answer to a question where, was the value for what I paid equal to, better, or lower than what you paid for? And you got 25% of your family saying, I actually think I paid less than what I got for value. It certainly does give you a lot of strength of ability to go and say, okay, we're going to have to add, another 4, 5, 6% just to cover, like we talked about before, covering the cost of operation. Nowadays, with inflation, increase on caskets and things like that, the average funeral home probably has to do close to a 6 to 8% increase on their GPL. And we talked about historically, that was usually 2.5%, 3% at most. And for a lot of people to look at deviating from historical trends to what is almost a requirement to keep moving forward in a profitable fashion, that's awfully hard to come to terms with unless you've got information from your families that are telling you, yeah, I mean, for what you do and what you provide, it was well worth what we paid for your services.
So I wish we had another hour because I have a lot of thoughts that are spinning off that. But many of you may be listening and saying, okay, well, where do I start? And I think that's where we'll close today. You don't want to overcomplicate this. I think what is important is for you to create a plan of how much time you need to spend in every area that we've discussed today. Without good customer service, you're not going to have the numbers to adjust and work towards. Without employees that are empowered to represent you as the owner in the community the way that you want them to, and to tell other people that they should work with you and for you, again, you're not going to have the numbers to manage. Okay, so if you're not spending any of your time on generating and getting access to this data, or focusing on your team, focusing on customer service, you're doing your financials a disservice, let alone the families. So I would encourage you today to leave you with kind of an action item of the first step is to sit down and look at the areas that you may be able to identify that are potentially neglected, and then create a plan of spending time on each one of those, not all in one. You need to look at the financials. You need to schedule a meeting with your accountant next week. You need to sit down with them. You need to schedule a meeting with whoever's doing your surveys. And if you don't have them, you need to start getting them. And you need to create some time one-on-one with your team members, maybe starting with your managers outside of the office, where you can get them to be honest with you and share how they feel. So this is all about a balance. You can't fix it all at one time, and you can't improve it all at one time, but you can make incremental improvements that's going to show up in the numbers. And then once you start improving those numbers and getting those numbers up, and then it's fun to sit down and talk about how you can improve each margin. So with that being said, Tracy, I'll let you make kind of a closing comment, and then Nelson will end it with your comments.
Yeah. I mean, Tim, you're so right. My area of expertise that I talk about day in and day out are the finances, but you can't operate just in that department only and expect to see everything go swimmingly. But I will say that from the financial standpoint, I hope no one is walking away from this today feeling overwhelmed by what we talked about. Really, the book that goes along with 60-Minute CFO, the first 3 words of it are keep it simple. And we really do need to remember that if we go overboard and we try to make this complicated, we just won't do it. So I urge you to pick a few things that you're going to focus on, like Tim said, and if I can narrow it down for you in finance, pick a few things that will really make a difference and start measuring and managing those. And the reason it's called 60-Minute CFO is we say take 1 hour per month. Take 1 hour a month and measure these and manage them, and you will see a huge improvement.
Nelson?
Well, it's hard to summarize any better than the two of you have already. I would say this, from the standpoint of what each one of you provides and what we do on a daily basis is the coaching. And if ever you wanted to get an incentive to go out and find yourself a coach, and that's not a commercial for Johnson Consulting, but just anybody, a trusted advisor, just Google the value of having a coach, and you'll have the world leaders on some form of YouTube or another telling you that it wasn't until they had a coach that they were elevated to another level. We use the analogy about talking about sports. We come into an operation, and if you were a baseball player, a high-level athlete, we're not going to tell you how to play the game of baseball, but every single one of them has a coach. How do I hit a little bit better? How do I get on base a little bit? How do I lead off on first? I mean, there's all those things that you're performing it, but their coach has to watch you from a distance and point out the things that you can't see for yourself sometimes. And they're all, like Tracy said, they're incremental changes that affect the outcome. There's a famous video out there about 212 degrees, and at 211, it's just hot water. But at 212, it becomes steam that can power a locomotive. And for most people, that's what they're doing. They're looking for that 1% more to put their operation into full power. So that's what I would say is, if you took anything from this, you don't have to put any one of us on speed dial, but find somebody that can be honest and trustworthy and give you good feedback, and then work on that.
Well, Tracy and Nelson, thank you so much for your time. I've put the contact information for the 3 of us on the screen. I would highly encourage you to reach out to any of us if you have questions or want to chat. Nelson, it's been specifically requested that we send out that cemetery data. So once we get the attendee list, we can do that. And we thank all of you for joining, and I hope you have a wonderful rest of your day. Take care.
Thank you.
Bye-bye.
Thanks, everyone.